One of the concerns is that if the Fed decided it wanted to get smaller, right now the Fed is getting bigger every month, but ultimately it's going to want to decide to get smaller. And it could be harder for it to do so if these entities exist that just invest in Fed deposits, because that would increase the demand for those deposits. And the Fed would have to meet that demand if they wanted to control interest rates. Another problem that the Fed is concerned about is that the Fed conducts monetary policy by targeting the federal funds rate. The federal funds rate is the rate at which banks lend to each other and on an uncollateralized basis. And right now, that market is very peculiar because of the fact that the Fed is so huge and provides such a large level of reserve balances that no bank really needs to borrow from each other. But what's going on is that GSEs, including the federal home loan banks, who don't get interest on their deposits at the Fed, take those and then lend the funds, instead of holding the deposits, lend the funds to a bank. The bank earns interest on the deposits, so they pretty much split the difference. And that is what's the Fed funds market right now. The Fed expressed the concern that if you had these narrow banks, the GSEs would instead invest in the narrow banks, and the Fed funds market would go away. And that would cause problems with the Fed's ability to target the Fed funds rate.